It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, His Honor himself, the Mayor of Beckerville, Mr. Michael Becker.
Hey, Paul.
So Michael, who is a former Wells Fargo commercial real estate banker, made the switch a number of years ago from being a loaner of money to being an owner of real estate. Now he has closed over 5,200 doors, 53. I don't know.
Yeah, that's right.
A lot of business.
A lot of apartments.
A lot of apartments. He certainly knows the apartment industry backwards and forwards. He was a banker for 15, 20 years.
About 15 years, yeah.
Yeah, long period of time. So
got out before you did, so it was good.
Yes, it keeps sucking me back in. But I love it. I would never do anything else. I absolutely love real estate, commercial real estate lending, and that's what my passion is. So on Ask Mike Mondays today, there's a question that came in from Shane, and Shane is out of Charlotte. Hi, Mike. I am in Charlotte, North Carolina. They are building lots, and I mean lots of multifamily currently, cranes in the air. It is actually priced well, starting at about $900 for a one bedroom, one bath. My question is, what type of product would you be looking for in a market like this? And would you go for C-class properties, or would you stay away from a hot market?
Yeah, so I've heard good things about Charlotte. I don't know a ton about Charlotte. Where we operate is in Dallas-Fort Worth. And I can't imagine there's too many metros across the country that are more competitive and more hot, I guess, than Dallas-Fort Worth. We certainly have had, quite a bit of construction here in our market, as well as, pricing has appreciated. So has the rents along the way, like most of the major metropolitan areas across the country. When we first started getting into buying and renovating and operating multifamily properties, what my group focused on was really kind of the Class C apartments. So really what that is, and in our market is, 1960s and 1970s built apartment complexes with limited amenity sets that are, kind of verging on the functional obsolescence. So, you come in, you buy a property, it has some deferred maintenance, you renovate it, you improve the interior, cure the deferred maintenance, you improve the interiors and the amenity sets and kind of make it from a C- to a C+. I mean, that's a great entry into the market. Anymore now, we pretty much have sold the vast majority of any of the first deals that we've done, all the C stuff. Now what my company focuses on is kind of the B to A-. So in our market, what that means is kind of mid 80s to mid 2000s. So, kind of think about, about 1983 to about 2008. So kind of pre-recession multifamily. And that's what I would consider the top end of the workforce housing product out there. So this is still a product that is largely housing by necessity, not necessarily the luxury lifestyle housing by choice. So the reason that we focus on that presently is because a couple reasons. One is, we now have a track record. We've successfully returned capital, I think, on 14 of the 25 transactions that we've done, either through sale or refinance. So we have the ability to attract, larger pools of capital. So we need to go buy larger properties. But really the main driver to it is just that as we presently sit, I feel that the top end of the workforce housing scale, not the top end of the market, the luxury stuff and the urban core with concierge and things like that's not really what we're focusing on. Just kind of the top end of the workforce housing scale seems to be better priced. What I observe in today's marketplace is a lot of the value add C-class properties are trading at similar cap rates to what the brand new stuff is trading at. I'm seeing these C-class deals in Dallas-Fort Worth. A lot of them trade with, a 5 in front of the cap rate. We sold one in West Fort Worth about a month or so ago, and I swear it was probably almost a 490 cap or something for a combo 68/1980, combo flat roof, pitch roof building. So it was nuts at what we could sell that for. So a lot of that is just money chasing it. People are trying to buy the value add story, which is a good story, but they're kind of overpaying with a lower cap rate today to then chase the upside in the future. So it seems to me right now, as we sit in the market that I function in, buying a little bit higher on the workforce housing scale seems to make sense. I don't think buying the top of the market where then you have to worry about direct new supply directly competing with you is necessarily the right fit. So that's kind of what we focus on. But all that said, a lot of the people, it really depends on the market, where you're in, and the market that you're looking to buy, their fundamentals are. So I don't want to blanket that across country or market by market. It's certainly market dependent, sub-market by sub-market. But most of the people that we loan money to, most of the people that start out in C-class, because that's the price point that they can afford, I still believe that's a good price point. We still are very active in loaning in it. I would just make sure that we're paying attention and make sure that you can fully validate the value add story that is there. Because I think, the price that is presently having to be paid for a lot of the value add stuff, especially in the C-class space, you're paying a much lower cap rate. And if we do hit a soft patch, I'm a little worried that might be the area that gets the most affected.
How about some of this mixed use apartments? I mean, I think a lot of this mixed use apartments is in, say, some of the urban core areas. There may be some in between urban and suburban. What do you think about some of this mixed use that's tied to an apartment building, which usually is maybe 5 or 6 stories, and then on the lower level is a retail center like a Starbucks or a painting supply store? I
don't have a ton of direct experience in it. Obviously, I think I lent on 1 or 2 back in my former life, but I certainly never owned or operated any of it. The financing, you just got to watch the financing and kind of look at the percentages. I believe to qualify for agency financing, so Fannie and Freddie, you have to have less than 20% of the income of the combined real estate be attributed to the commercial space to be able to get the Fannie and Freddie financing. If you have more than that, then you get kicked out of one of the greatest government subsidies in the world, which is apartment financing right now.
The greatest.
Yeah, it's unbelievable that the agency financing out there is just simply unbelievable. It's unparalleled in the commercial real estate space, and which makes apartments have so much more advantages over retail or office or industrial right there. So keep that in mind. Then when you're going through and doing your market survey, you obviously have to have a little bit of variety in your skill set, because of the apartment function of the apartments component of the real estate will function in one way, and then the retail component, or if you have office in there, those will function a different way. You need to make sure you understand it. You have your TI allowance and leasing commissions and all that stuff built in there, as well as when you have a vacancy in the retail, it tends to be materially longer time frame before you backfill it, even though the leases tend to be a little bit longer. I mean,
that is absolutely correct. And what we see too in some of these retail locations, they're non-credit tenant investors. So if the economy goes south, they can just jump out and not go anyplace. If they were accredited investors, accredited tenants, I'm making this stuff up, but let's say it's a Walgreens in there or a Costco or something that actually has Wall Street credit, they're not going to jump out of that. But most of these little retail mom and pop
bakery or nail salon, something like that.
Yeah, they can just jump out pretty quickly. But just like what Mike was saying is that they will typically be longer vacant until you can find somebody that's going to fill in that space. And so if you go down, drive through some of these neighborhoods and you take a look at some of these mixed-use properties, whether they were just built or they were built 5 years ago, some of these spaces have taken a long time to fill up. So that's usually the last piece that goes in. It can be a very lucrative piece because it kind of adds into it. But again, the most you can have for space on retail out of the total building square foot is 35% retail. 35% retail, that's the max. The rest has to be residential rental, so then you can qualify for Fannie Mae.
And the income is 20% or less of the total income can be attributed to the non-residential component.
That's right. So some great information concerning what's going on out there, and that if people wanted to get to know you a little bit better, Michael, and a little bit about what SPI does, tell us a little bit about what's the way to do it.
Yeah, the best way to reach out to us is through our company's website. My company's SPI Advisory, so our website is www.spiadvisory.com. That's SPI like spy, advisory.com. There's a contact us page. Fill that out, and I'm always happy to have a 10 or 15-minute telephone call with listeners of the podcast.
That's great. Some great information that comes from Mike. And then if you have a chance, go back into Stitcher or iTunes and give us a 5-star rating if you think we bring valuable content to, the apartment or real estate investing, things that you have some interest in. Just let us know what you think of it so we can let more people know to join us in the conversation. And if you think somebody in your close circle of friends, whether you're in a real estate investment group, let them understand that we offer this stuff. We've been doing this for a number of years. I've been in commercial real estate lending for 34 years, worked for some of the biggest banks in the world. world. And Mike is a former banker. So
yeah, I think we're almost in our 4th year doing the podcast too, which is unbelievable that we've stuck it through this long too, which is great.
40, 50,000 listeners for these podcasts. We do appreciate everybody listening and tuning in. Don't forget, we have Dr. Mark Dotzer coming in the 28th of March. This is a great economist that used to be the Texas economist for Texas A&M University. He's retired right now, but he is a wealth of information. It is just not Texas. It is definitely not Texas. He is a national economist and pretty damn funny, would you think?
Yeah, he takes a very, what could be a very dry subject, and he injects a lot of humor. He's very entertaining in the way he does his presentations.
So don't forget to go on to the Old Capital podcast and register for Dr. Dotzer on March 28th, and then we'll have another speaker series at the end of February too. We'll let you know a little bit more about that.
That's at oldcapitalpodcast.com. That's how they can register and get a ticket to the event, because we will require you to register and get a ticket, right?
You definitely would, because Dr. Dotzer charges a big fee, and I want to make sure I know everybody who's coming.
So Paul's going to pay for the fee. You don't have to. In all seriousness, when we've heard him speak in the past, having been part of the Old Capital, I know we spent $100 a ticket to go to breakfast and listen to him speak before. So this is a great thing that Paul's going to subsidize for everybody. So I certainly encourage you guys to put that on your calendar, block off that day, and come out. We'll start around 6:30, but we'll probably open the doors a little closer to 6, have some networking, and get out. And that's a good way to kind of meet and mix and mingle with other people that are in the business doing apartment syndications. There'll be multiple brokers there, management companies. So it's a good way to get out and start getting networked and pressed in the flesh and meeting people. And you never know where those relationships can take you professionally.
Absolutely. So some great information. We do appreciate you listening. Mayor Becker, we appreciate your time, Your Honor. And I'm Paul Peebles. Have a great day.